Welcome to episode 1 of Credit Analysis, and our key topic for today is to understand credit spread. That is, understanding what you are actually being paid for when you buy a bond. Or before doing any calculation, let's take a real life example just to get warmed up. Here I pulled a FINRA fixed income data platform screen where you can see bond information for various issuers and bonds. What we have in the screen is Air Canada bond, which is maturing in August 2026, that is just 3 months out. Its yield at the moment is 5.13 as of recording, but if you see treasury rate for 3 months, that is using US Department of Treasury data, the yield that you'll see over here 3 months is 3.68. This data is as of May 1st 2026, but it's good enough for approximation. So our question is, what explains the delta between these two numbers, 5.13 that you saw in the FINRA screen and treasury bond treasury rate 3.68, which is roughly around 145 basis point difference. We won't use this data for a simple reason that computing the real delta is harder than we think. Institutional investors use an advanced measure or spread called option adjusted spread, which requires advanced techniques like binomial trees, which is not required at this point. But the important thing is that even though we are skipping, it's good to know that there are other non-credit measures that help build up the spread, and we'll explore those in later chapters. So having said that, the true scope of this video is to just understand what explains the credit spread in a bond. And back to our slide, in order to do that, we'll use an example. Imagine that you bought a $1,000 bond from a company which issued bond at 5.86% rate, whereas current rate for a government bond, which is a risk-free rate in the market, is 4.5%. So the true question is, what explains 136 basis point difference? And as you can see, it's the compensation for risk. But what explains this risk? And for this one, we'll see, and we'll also build it in the spreadsheet, is that it can be explained using 3 numbers. First is risk-free rate, which you saw is 4.5%, default rate or recovery rate, which is just 1 minus default rate. We assume that it's 35% of a bond defaults at any point of time. You'll only be able to recover 35% of money. That's what it's saying. And finally, annual default probability. This is also called hazard rate. It's conditional. We'll see how that works in the model, and that number is 2% for now. So rather than working with the slides, let's move to the model itself and start building it one by one. So here, as you can see in the screen, I have input all the numbers which are required, which is risk-free rate of 4.5%, recovery rate of 35%, face value, which is the amount of money that you lend, is $1,000, default probability is 2%, and let's assume that this bond will mature in next 5 years. So building the model from the scratch, over here you can see exposure at default. Because your bond is 5 years out in the future, at the end of first year, the value of your bond will be 1,000, and I'm gonna double bracket it, divided by 1 plus your risk-free rate. Okay, so this is for year 1. Now we can expand it till year 5. So you'll see at the end of 5th year, your bond will move towards 1,000, which is the face value, which is expected. Your recovery at the end of year 1 is simply your exposure into your recovery rate, which is 35%. And I'm gonna double quote it. Loss given default, if it defaults, so the loss is simply your exposure minus recovery. Alright, here's where conditional probabilities come into the picture. But for the first year, your probability of default is gonna stay at 2%, and your probability of survival is gonna stay at 1 minus 2%, which is 98%. But for the second year, because you have survived in first year, your probability of default is going to be probability of survival, which is 98%, into 2%. So you'll see it reduces to 1.96%. The way you can think about it is that you've already survived first year, so as you go into the second year, your probability of default is going to decline, because 1 year, the default for 1 year is out of the way. The chances of default for 1 year are out of the way. So I'm gonna just copy paste it, and the formula remains the same, but for this one your probability of survival also is going to be conditional, which is 98% minus 1.96, expanded to 5 years. Now expected loss is simply your loss given default into your probability of default. Discount factor is simply, it's just discounting by risk-free rate divided by number of years, raised to power number of years. And finally, present value of expected loss is expected loss into that discount factor. So here we have it. This number that you see is called CVA, credit valuation adjustment. You can also see this number over here, this place, 50.11. What it shows simply is that if you buy a default free bond at this point of time, which is a government bond for $1,000, at this point of time you will get it for $802, because you'll discount it by 4.5% for each year. The value at present time will be 802, but because our corporate bond has some credit risk, which is further explained by your default probability and the recovery rate, which we saw in the slide, the value of your bond declines by 50.11. So that means that you are paying less now to gain an exposure at the end of the 5 years of $1,000. So which means that you are essentially taking some risk to purchase this bond. And at the end of the day, using this simple calculation, I'll share the spreadsheet in description. Your yield to maturity using simple calculation is going to be 5.85, which is definitely higher than 4.5% risk-free rate, and your credit spread, as we saw in the slide, is 136 basis point. So to simply put, when you see any spread in the market for any bond, know that it's built of different measures, and because we are studying credit risk, your credit risk is defined by your probability of default and your recovery at any given point of time. Going forward, this is a very simple example, because what we have assumed is that there are no coupons and you'll only get $1,000 at the end of 5 years. But more advanced topics will cover coupons, which will change every year, even your yield will change every year, or your probability of default can change for every period. And then we'll also build on top of that the concept of option adjusted spread, where we'll also explain how a call option or a put option will change the calculation of CVA going forward. But for now, this is what we mean by credit spread, and as I explained, it's defined by two factors called probability of default and loss given default.